Okay, we're going to go ahead and get started. I think we have all the participants already logged in. So welcome again. This is Aura Ogorian. I'm with ACap Advisors and Accountants. And today's webinar is going to be about understanding student loans. And student loans are the largest segment of growing debt in the United States, faster than any other segment. And it's pretty clear because the cost of education is rising so much. We just did a recent analysis for someone where we were trying to calculate how much it would cost them to send their child to college in about 12 years. And for a private school, it's going to cost about $400,000 for the entire 4 years of education, which is just astonishing if you think about the continuous rise of the cost of education and how much it rises faster than inflation. And it's also clear with the rise of student loan debt, which we're going to go in deep detail today, not only on the types of student loans, but how you can schedule a repayment program. So let's go ahead and get started. I also want to point out that this webinar is being recorded. So if you are not able to watch us or listen to us the entire time, we're going to post this on all of our social media platforms. It's also going to be available for viewing on our YouTube and website. We are, as I mentioned earlier, the student loans are a massively growing segment of the entire loans population in the U.S. The total amount of student loan debt is over $1 trillion, and it's growing every year. So today what I want to do is talk about what are the different types of student loans that are available both to students and to parents, the types of income-driven repayment programs. And these are really, really important because once a student is out of college and then the repayment starts, this is where the real confusion starts. So I want to really talk a lot about that. I'm also going to talk about the Public Service Loan Forgiveness Program, which is a relatively new program that started about 10 years ago. And this is a program that applies to people that work in public sector and also in the government, nonprofits as well. And then lastly, I'm going to close off by talking about loan refinancing and consolidation options that are available for people who have different types of student loans. Because what happens is, as a student progresses through their academic career, they're going to have different types of student loans. They're going to have graduate loans if they go to graduate school, undergraduate loans, and refinancing consolidation really come into play once they've completed their school and they're trying to figure out ways of paying back that debt. So let's talk about what are the different types of student loans. And if you look at the entire universe of student loans, there are basically two general types. There are federal student loans and there are private loans. On the federal student loans, you have Stafford loans, Perkins loans, and then parent or plus loans, not only parent loans, but just plus loans. So on the Stafford loans, these are directly made to students. The benefits are there are no credit check required and no collateral required for the Stafford loans. They are eligible for consolidation, which we'll talk about later. On the Stafford loans, they could be either subsidized or unsubsidized, and I'll talk about that in a little bit. And also, they are, like I said, eligible for consolidation. The Perkins loans, they are no longer offered as of September 30th, 2017, but there are a lot of people that still do have Perkins loans. And it's applicable here because when you're talking about income-driven repayment programs or consolidation, the type of Perkins loans you have or the type of loan that you have will determine whether or not you can consolidate or if you're eligible for an income-based repayment program. The last category are PLUS loans, and PLUS loans stands for Parent Loans for Undergraduate Students. And they're both for parents and for graduate students. So initially they were for undergraduate students for parents, but it's been recently expanded to include PLUS loans for graduate students as well. Now these loans are based on credit. So they're going to run a credit check for you to see if you are eligible. And these loans are also unsubsidized. So whereas the Stafford loan is subsidized, the PLUS loans are not subsidized. They're unsubsidized. Lastly, the other type of loan are private loans. These are taken out usually with private banks, whether if it's a large multinational bank or sometimes there are non-bank lenders out there that do lend for student loans. The terms could be either fixed or variable. They're usually a lot shorter terms than they are for the federal loans that you would typically get. Private loans are based on your credit score, and they also may require a cosigner. So if you're just starting out in college, you most likely don't have a good credit score or a good credit history. So as a result, a parent or someone that you trust will have to cosign for that loan. And then the interest rates can be based on a number of factors. They could be based on your credit worthiness, collateral if there's any, and then also your income. But in a student's case, if there's no income or collateral or credit worthiness, that's when the cosigner really comes into play. So let's talk about the Stafford loans and the difference between a subsidized and an unsubsidized loan. The subsidized loan is based on financial need, and during your education while you're in school, the interest is paid by the government. So the interest, even though it accrues, is paid by the government, so there's no what's called capitalized interest, which I'll talk about in a minute. The unsubsidized loans, these are not based on financial need, and it's not based on financial need, and it's not also based on your credit score. The school determines how much you can borrow, and while you're in school, the interest that accumulates is capitalized because the government is not paying for it. Now, what does that mean that it's capitalized? What that means is, let's assume you borrow $10,000 and you don't borrow any more, and you borrow that in your freshman year in college. When you graduate, the interest that accrues on that loan will get added on to the principal. So it is possible for when you graduate, you will owe more than that $10,000. It might be $12,000 or $13,000, because during the time when you're in school, that interest that was owed on that loan gets added on to the principal. Whereas on the Stafford subsidized loans, when you graduate, you still owe the $10,000. The interest that was owed on there was paid by the government. So hopefully that makes sense. If it doesn't, I should have mentioned this earlier. Please, if you have questions, ask your questions in the chat box below. We'll get to all the questions at the end, I promise. And like I said, this is being recorded and it's available on many of our different platforms. Okay. Now we know about the different types of student loans that are available out there. There's nothing more confusing out there than the income-driven repayment programs. And as I go through it, you'll understand what I mean by the confusion that's caused by many people when they get out of school and what their options are when it comes to paying down their student loan debt. Let's talk about different categories of income-driven repayment programs. There are 4 primary categories. There is the pay-as-you-earn. There is the newly revised pay-as-you-earn as well. It's called the Repay, that came out in 2015. There is the income-based repayment program. Sometimes it's confused with the income-driven repayment program or plan. And they're not used interchangeably because the IDR, the income-driven repayment plan, is all the different programs that are available under the IDR. And IBR, which is income-based repayment, is a part of the income-driven repayment program. So as you can see, it's already confusing enough, and I haven't even gone into the details of each plan. The last one is the income contingent repayment program. So now that we know the 4 different types, let's go ahead and talk about each one individually. First, we'll talk about the pay-as-you-earn, because the pay-as-you-earn was introduced in 2012, and then the Repay was introduced in 2015. So the way the pay-as-you-earn works, and all the repayment programs, the way they work is they try to cap your payments based on your income, and they do that so that way they don't want to. The government doesn't want to burden you with having too much student loan payment, monthly payments, that's not going to be in line with what your income that you're making. So the the pay-as-you-earn program, the way that it works is the payment is capped at 10% of your discretionary income. Not all loans qualify for the pay-as-you-earn program. Only loans that were issued on or after October 1st, 2007 are eligible for the pay-as-you-earn program. Also, any outstanding balance on your loan after 20 years is forgiven. So for example, let's assume that on a regular standard program, your payment is $500 a month, but under the pay-as-you-earn program, your payment is now $150 a month because your income is not as high to qualify for the higher payment. And then you pay for 20 years, and after the 20-year period, you have another $20,000 left on your student loan debt. That amount under this program will get forgiven. However, keep in mind that any amount that's forgiven under the pay-as-you-earn program is taxable to you. So continuing with the same example, if after that 20-year period you have $20,000 that's forgiven, that amount is going to be taxable to you in that year. So take that into consideration, because that's a very important factor that people don't really know until after it happens, and then they get this huge tax bill. On the pay-as-you-earn program, spousal income is also considered, but not if you're married filing separately. Now, I know that sounds a little confusing. Sometimes what happens is you have one spouse that earns a lot of money, the other spouse does not earn a lot of money. The spouse that does not earn a lot of money wants to do the pay-as-you-earn. They can do married filing separately, so that way the spouse that's not earning as much money can qualify for a lower payment based on that lower income. That sounds great. However, keep in mind that if you live in a community property state, you have to file, even if you file separately, you have to take into consideration your spouse's income, which could be higher as well. So that kind of defeats the purpose. All of the IDR programs qualify for the Public Service Loan Forgiveness Program, which we'll talk about later on in the presentation. The other program that's available is called the Repay, which is the revised pay-as-you-earn. That was introduced in 2015. So like the pay-as-you-earn program, all federal loans are eligible regardless of loan disbursements. So as I said earlier, the pay-as-you-earn, only loans after October 1st, 2007 were eligible. Under the revised pay-as-you-earn, all loans are eligible. So that's a real big benefit. The payment is still 10% of your discretionary income, and it's calculated every year based on your income and your family size. And the balance is forgiven after 20 or 25 years, depending on the type of loan that you have. So if you have a graduate loan, it's 25 years. If you have an undergraduate loan, it's 20 years. Same principle as far as taxation of the forgiven amount. After that period of 20 or 25 years, if there's a loan balance remaining, then that amount is taxable. One other difference between the Repay and the regular pay-as-you-earn program is that both spouses' incomes are considered, whether or not you file separately or jointly. So initially, when I said that you can file separately if you're married and take the lower income's spouse's income, you can't do that in the Repay plan. Lastly, the Repay program is also eligible for the Public Service Loan Forgiveness Program. So I just want to reiterate, as you can see, we're only talking about 2 of the 4 income-driven repayment programs, and it's already confusing as it is. And like I said, this causes a lot of trouble for people who are graduating and trying to figure out which is the best course of action for them as far as repayment programs. The next income-driven repayment program is called the IBR. It's the income-based repayment program. And with this program, you have to certify your income every year to show that you're eligible for this program. Same principle applies. It's 10% of your discretionary income. However, only if the loan was taken out after July 2014, and then it's forgiven after 20 years. If that loan was taken out before July 2014, then it's 15% of your discretionary income. And the same principle applies as far as the forgiveness after the 25 years or 20 years, depending on the type of loan you have, the amount is forgiven, and it's considered taxable income. Okay. Just want to remind you again, if you have questions, please go ahead and ask them. I will get to all the questions towards the end. Oops, let me go back a little bit. We talked a little bit about this. Okay. Let's talk about the income-driven or income contingent repayment program. With the income contingent repayment program, the loans are forgiven after 25 years, and the payment is a lesser of 20% of your income. And it's the lesser of 20% of your discretionary income or a 12-year repayment program. So as you can see, it's not as generous as the income-based repayment program, but the forgiveness period is a lot longer, and it also covers more types of loans as well. And lastly, it also is eligible for the Public Service Loan Forgiveness Program. Okay, now that we know all the different types of income-driven repayment programs, let's talk about the Public Service Loan Forgiveness Program. So this is also relatively new. It came out about 10 years ago. And the Public Service Loan Forgiveness Program, the benefit is that it can be used in combination with any of the income-driven repayment programs. So that way, not only can you lower your payment, but you can have the loan forgiven after you make 120 qualifying payments. So let's define what that means. If you are part of the Public Service Loan Forgiveness Program and you make 120 qualifying payments, they do not have to be consecutive, but 120 qualifying payments, then your loan balance, whatever is remaining, gets forgiven. The real benefit is that whatever is forgiven is not taxable. So if you recall, I was discussing the different types of income-driven repayment programs and how once the amount was forgiven, it was taxable. Under the Public Service Loan Forgiveness Program, the amount is not taxable. So that's a huge, huge benefit. The catch is that you have to work in a public sector. So you have to work in government or you have to work in a nonprofit. And it does not have to be consecutive. So let's assume that you work for a nonprofit for about 5 years, and then you go work for a for-profit sector so you don't qualify anymore. And then you come back to the nonprofit or government sector. As long as your payments are qualifying after you've reached 120 payments, then your loan is forgiven. Now, that sounds simple enough, but because people do these in conjunction with the other income-driven repayment programs and a typical loan period is 10 years, you have to really crunch the numbers to see if it makes sense for you to be participating in this program. All right, so we talked about the Public Service Loan Forgiveness and how you'd qualify. You have to also work full-time. I failed to mention that. What you can do is you can consolidate all your federal loans. So the drawback is you cannot have private loans be part of the Public Service Loan Forgiveness Program. And you can apply for any one of the income-driven repayment programs to qualify for the Public Service Loan Forgiveness. Okay, let's talk a little bit about loan consolidation and loan refinancing. So loan consolidation is typically done through the federal government, and with the loan consolidation, you would go through, have all of your different types of loans, whether if it's subsidized, unsubsidized, the Parent Plus or the Grad Plus, and you would consolidate them all together so you have just one loan payment versus having 7 or 8 different types of loans, depending on how long you were in school. The benefit of that is that you have that one loan payment and only one servicer that you're paying. The other benefit is that it takes the weighted average of all your loans, the interest rate on your loans. So if you have one loan that's 7%, one loan that's 5%, one loan that's 9%, it takes the weighted average of all those, and then it determines that consolidated loan rate. So that's a big benefit of it. And again, it's only through the federal government. Refinancing, which is also relatively new, is done through private lenders. And you can do a refinance with many of the banks or non-bank lenders out there. The benefit of refinancing is that your interest rate is typically lower than you would with a consolidation. Now, they do that because the term of the loan is lower. So instead of paying it over 10 years or 20 years, the term is now shortened to 5 years. So your payment's going to be a lot higher. I think there's a chart over here. So the payment is going to be higher with a loan refinance with a private loan, but you're going to end up paying a lot less in interest than you would otherwise with doing an income-driven repayment program. So just recognizing. The other thing is recognizing that you're going to pay less interest and you're not going to qualify for the income-driven repayment programs. The other drawback to a loan refinance is that if you do a loan refinance and you come and you go work for a government sector or nonprofit, you're not eligible for all the other perks that are available for a government loan, because now you refinance it and you have a private lender. So keep that in mind when you do the refinance. Okay, we talked a lot about the different types of loans that are available and also the different types of income-driven repayment programs, as well as the public service loan forgiveness program. I know that was a lot of information, but now I'm going to open it up to any questions that people have, and I'm happy to entertain those questions. Okay, so let me get to the first question. All right. Well, the first question is, can I use a HELOC, a home equity line of credit, to refinance my loan? That is a really good question, and it depends on, well, it doesn't really depend anymore, because a new tax law that went into effect prevents you from using a HELOC loan to deduct the interest on a HELOC loan if it's used for any other purpose besides improving your existing house. So first, let me define what a HELOC loan is quickly, and then I'll describe why it's not deductible. A HELOC loan is a home equity line of credit. Typically, it's taken as a second on your home with your primary mortgage. And historically, what people would do was they would take a home equity line of credit, they would buy a car, or they would refinance like credit card debt, and then they were able to deduct that interest on their taxes. That's no longer allowed with the new tax law. The only time you can deduct a home equity line of credit is if it's used to improve your existing if it's used to improve your existing home. So if that's the case, then you can deduct it. If not, then you cannot deduct it. Okay. The next question is, do I have to work for the government for 10 years to qualify for the public service loan forgiveness? No, it does not have to be 10 consecutive years. It could be, it just has to be 120 qualifying payments. And a qualifying payment is a payment that's made while you are working for a government entity, a government entity, or a nonprofit entity. But it does not have to be consecutive years of payments. Okay, let's see if we've got any other questions that we have not already answered yet. All right, I think those were all the questions we had. If there are any other questions, please feel free to contact me. My information's on the bottom there. Feel free to email us, and we'll go ahead and answer those questions separately. Thank you very much for joining us in this webinar. Hopefully it was informative for everyone. And thank you again. Have a good day.